seasonality wise lines up. The stock market is telling us that it's not very strong. It's still going higher, but it's not very strong. It's on the cusp of a big reset. So gold to me is that big barometer saying if gold is going up and outperforming, you got to be aware that some big bad news is lurking out there. We're going to have something hit the market and we won't know until it hits, but it's going to turn the markets around and it's going to crash and it'll probably be what the next, bear market will be labeled after. So that's where that's where gold to me shines as that very big global trigger saying, be aware. It might not happen yet. Like now, it could be a couple months down the road still, but something big is brewing.
Gold has emerged as the top performing asset class of 2025, rising 29% year to date and outpacing major equity indices, bonds, G10 currencies, and Bitcoin, according to a report released by UBS on Tuesday. Based on seasonal trends, market specialist Chris Vermeulen notes that gold is likely to post strong gains from August through October. Vermeulen placed particular emphasis on the behavior of gold, which he considers the ultimate barometer of fear in the market. While acknowledging gold's recent impressive rally to its 100% Fibonacci measured move, he cautioned that this blow-off phase could be a deceptive peak before a significant pullback. Gold prices have risen for 5 of the past 6 days, boosted in part by hopes the Federal Reserve will soon cut interest rates in response to weakening economic data. Futures prices in New York had briefly traded near $3,500 a troy ounce Friday before retreating. Beyond technical indicators, Vermeulen notes that gold miners' breakouts often precede a similar move in physical gold, signaling potential upside. He cautions that such outperformance in overheated markets can foreshadow equity market corrections and a flight to safe haven assets. In his outlook, Vermeulen draws parallels to 2007 and 2008, when gold surged 38% as the S&P 500 dropped 20%, suggesting current conditions may signal a similar shift. He urges investors to view gold's strength as a warning and prepare clear equity exit strategies ahead of a potential market reset. The S&P 500 and gold ratio is now hovering near levels seen at previous cycle tops in 2000 and 2018, just before significant market pullbacks. With yields remaining below historic highs and liquidity tightening, the setup bears resemblance to past deflationary environments. At the same time, gold's continued strength in 2025, on track to outperform stocks again, further supports this thesis. Before we dive into Chris Vermeulen's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
It's really interesting. So when we look at this is the daily chart of gold futures, you can see today gold hit new all-time highs. But I believe gold is on the cusp of a big breakout and a big move. I do like when I'm trading gold because I am looking at getting into gold for a trade to catch this projected move to the upside, which let's just take a look at this projected upside. So using technical analysis and Fibonacci extensions, we can get a gauge of where the next upside moves for gold will be. And based on Fibonacci extension, it is showing us that we should go to $3,725, potentially all the way up to about $4,100. So there's about 18% upside from here. Now, I'm excited about it, but I don't really want to get into it until gold breaks out to new highs. And you're going to say, well, it has broken to new all-time highs. Well, the way I like to follow gold is actually through regular trading hours, 9:30 to 4. That's when the majority of volume is traded. That's where price can't be manipulated as much. And because what we saw today was a spike up in gold as London Exchange opens and closes and pre-market and post-market. There's easy manipulation and movement. And so gold had that spike. The best way to look at it is to look at like an ETF, the PHYS, like the Sprott Money Management, the gold ETF. If we zoom in here, you'll notice if I draw a line across the highs here, we haven't really broken to new all-time highs yet. I want to see gold on a regular trading hours only chart break and close above here. And then I'll be like, okay, gold has now broken out. It's starting another run. This is going to be a significant one. And there's a few other things that are really juicing gold to go higher. We have one of the simple ways to look at it is just the seasonality chart. You and I have looked at this a few times, David, but here we are literally at the low where in August, like pretty much right now, where gold usually turns around and rips higher for 2 months. So we have now a tailwind behind gold, behind our bullish chart pattern. So that's a really bullish sign. And the other thing to look at are we've seen gold and silver miners. They have now broken out. They've already broken and started to run. And when we're in a very unique precious metals specific, like rich environment, like I feel like we just finally turned into that. Gold miners tend to lead the way, meaning gold miners will rally 3 to 7 days before physical gold breaks out. I've seen this so many times in the past. So the miners give us this warning, and now we're like, okay, now that we know it's about to run, gold should be the next one to follow suit. Because the smart, aggressive, savvy money who realize this market condition we're in, they moved into miners because they see gold going higher and they want to take a leverage play on it. And so that's why I really like gold. Is it's a day or two away potentially from breaking out and starting a significant run. When gold starts outperforming and running higher, especially in an environment where it feels everything is frothy, things feel out of control somewhat with equity pricing, and what's going on with presidents and rates and all that stuff, gold tends to do really well. A good comparison is, and you and I have touched on this in the past, is if we take a look at this chart on the left. This is the S&P 500 in 2007. We saw the stock market make a high. It had a very big correction to the downside, and then it rebounded and made a nominal new high. Now, gold is the yellow line. Gold was outperforming. It was a top performer, even when stocks were hitting all-time highs. If we look to where we are right now, the stock market has done a similar. It had a big correction this year. It's rallied back. We're now making some nominal new highs. And gold is doing the same thing. It's outperforming. It's one of the best performing assets long term at this moment. And gold is, when people get nervous, they're scared about stocks, they're scared about real estate, they're scared about currencies. They move to physical gold. They get out of the financial system and they buy a bunch of shiny gold pet rocks and silver rocks, right? That's telling us that people are fearful and that something bad is brewing. Now, if we look at 2007, as the stock market starts to sell down, the candlesticks, gold starts shooting higher. And gold ended up shooting up almost 38% to the upside, while the stock market fell 20%. And we're very close to something similar. The gold daily chart pattern is pointing to a 20% move. Seasonality wise lines up. The stock market is telling us that it's not very strong. It's still going higher, but it's not very strong. It's on the cusp of a big reset. So gold to me is that big barometer saying if gold is going up and outperforming, you got to be aware that some big bad news is lurking out there. We're going to have something hit the market and we won't know until it hits, but it's going to turn the markets around and it's going to crash, and it'll probably be what the next, bear market will be labeled after. So that's where that's where gold to me shines as that very big global trigger saying, be aware. It might not happen yet. Like now, it could be a couple months down the road still, but something big is brewing. And we just need to you have to have a game plan, because when things turn around, especially for the stock market, you better have an exit plan.
While the bulls continue to warn about the impending economic disaster, the price action remains extremely strong. On Friday, there was another good example of intraday strength, with the S&P 500 trending higher most of the day. The Magnificent Seven stocks are driving U.S. equity gains, but market breadth is weakening, sparking caution. Analyst Chris Vermeulen warns of a potential 15 to 25% market pullback, drawing parallels to the 2000 and 2008 crashes. Vermeulen believes that rising rates and gold's resilience could signal a stage 4 bear market. With the 10-year yield targeting 8%, he foresees a multi-year downturn. The next week is critical, as it may confirm either a breakout or the start of a major correction. Historically, during major stock market downturns, investors could rely on two primary safe havens: Treasury bonds and gold. In the current environment, this correlation has undergone a fundamental shift, as Treasury bonds are no longer serving as a reliable safe haven. Ultimately, Chris Vermeulen notes that a recent rally and pullback in gold miners may signal a coming move in physical gold. He highlights that, unlike mining stocks, which are subject to equity market volatility, gold can rise during market sell-offs, historically delivering more consistent gains during periods of stress. Let's get back to the interview.
The stock market moving higher, I think today, and really over the last couple of days when it has been pushing higher, is very much so related to the Magnificent Seven. when we look at like the S&P 500 and the NASDAQ are both very close, striking distance to breaking to new all-time highs again. And really, it's the Magnificent Sevens that are pushing things up. We're seeing big moves in Nvidia, Tesla, Apple. All of them are really pushing and driving this market up. What's really interesting here, though, is we're at this really, really critical turning point. If we look at the overall trend, if we look at my trend analysis on the stock market, this is the S&P 500. More or less, we had the exit trend sell signal with the tariff crash. We had a new trend start. And just this week, we ended up closing out our equities position up here near the highs because the technicals are actually breaking down. A lot of technicals and sentiment. The market's actually not very strong, but the Magnificent Seven are doing pretty much all of the heavy lifting. And so right now we've moved to the sidelines and we're waiting. We could see this market kick back into an uptrend, and this will be a nice reset to put our portfolio right back in and catch the next leg higher and things like that. Or it might sell off and go into a bigger correction. And as I was mentioning to you before, just before this, David, if we look at this comparison chart of this year of the NASDAQ, the QQQ, and last year over pretty much the same time frame, we both had a big, significant April low. We had a massive multi-month rally, and we had a very similar type of trend reversal and breakdown in the markets. And that's what we're seeing right now. And our system has identified it again, saying, hey, the same shift is happening. Move out of the markets. Let the market figure out which way it's going to go. And then we can take action from there. So last year, we saw the markets fall about 15% down to the April pullback. The same thing could happen this year. Maybe it could be 25% because we're a lot higher. So anyways, there's an interesting scenario here. And the price of gold, which is the other half of what we're going to talk about, is also signaling that this a big correction is here. And gold is one of the biggest, it's kind of like a global barometer that we're going to go into some financial crisis in a big way. And that's why I think gold is performing so well, and why gold, I think, is close to a 20 to about 40% rally, depending on what happens over the next really week or two, or really actually just next week. I think we're going to have a significant change where we have big trends, either up or down. We just have to let these assets break out, whether it's gold or the stock market going forward. I'm expecting if we see this correction, obviously it could be a 15 to 25% correction. It could bring us back down to the lows we saw earlier this year. But when I say something really big, that actually brings us back to the stage analysis where we look at these four stages of the market. And I believe we could go off this cliff into a stage 4, a financial reset, a bear market. Like we're talking a tech bubble burst, a multi-year bear market, the financial crisis of 2008, the 87 crash. We could see a huge financial reset. And gold has been warning that something bad is coming because it's been going up and it continues to hold its value. Interest rates, when we look at the 10-year, I mean, nobody really wants to see this because it's going to be really painful, but the 10-year yield has a very strong chart pattern. When we go way back in time, everybody's used to falling rates because that's what most people just kind of grew up with. But this was a stage 3 topping phase. It went into a stage 4. We've just seen the interest rate market more or less put in a massive bottom, and it has a launch pad to start a new bull market. It is pointing to an 8% rally. Obviously, if that was to happen, it's going to wreak havoc for the economy, for the world, for stocks, for real estate, and all of that stuff. So that is like when I say something really bad could happen, that could be the scenario. That's what interest rates are pointing to. Gold has been warning us for a while. So that's like the worst case scenario. Obviously, the comparison of 2024 is saying that would be the first leg, the first potential pullback to be aware of going forward. But we really just need to wait and see. We just need to give it a few more days. Don't get worked up. Let the market guide us. There's a huge difference between timing the market, which is what most people try to do. They try to pick a bottom. They try to guess a top versus following the market. Let it put in a top, let it roll over, and then identify the trend. Let it find a bottom. So that's what I do. I follow it. I don't get all antsy and try to split hairs and pick tops and bottoms. I let the markets guide us and just follow. It's way easier to follow than it is to predict the future. So hopefully that kind of explains the we could have a pullback that could lead into a financial, reset. They're in the gold camp, but here's the problem. So, for example, if we were to take a look at what gold miners have done recently. So there's this very significant standout low, this high volume low. We had the rally up, the high volume rally, and we had this pullback. Using Fibonacci extension, if we bring that forward, it has done exactly what it should have done. Gold miners pulled back. They rallied up to the 618. They paused, which is what you want, because if it pauses here, it usually is going to hit the 100% measured move. So gold miners have now hit this move. And in this particular market scenario, it's a very short window that they work like this. Gold miners move first, and then physical gold moves after. So kind of missed that move in gold miners. They finally have come to life and outperformed gold. But now we can be like, okay, let's shift over to gold. Let's play the breakout on gold, which has about a 17, 18% upside move. But miners, if gold break out, miners should continue to move. I'm just not as big of a fan of miners for a couple of reasons. They're more volatile. They sometimes will, if the stock market does sell off, David, and gold goes higher, miners can actually still sell off. And that's because when the stock market goes down, most stocks go down, and gold miners are a stock stuck in the stock market. So by going physical gold, you've got out of that pocket of stocks, and it doesn't matter what the stock market does. Physical gold can keep moving up. So that's kind of the reason why I like gold miners should do okay. But even if you go back to 2007 market top, gold was the number one performer. It held up and made stronger gains than gold miners and silver, simply because it's seen as the global safe haven, whereas miners and silver are more of a North American speculative play. So if you have the whole world moving into gold because they're getting nervous, it has a lot more power and more stability than us North American people being more speculative, trying to pull money out of the market and dance around things. So there's no doubt they'll probably move higher, but gold has actually made more in this same scenario percentage wise than miners. So why not do physical gold, have a higher probability of winning and making more money than going into miners just because, they can move fast, but not always.
UBS maintains an attractive rating on gold in its global preferences, noting that hedges remain highly relevant as market participants continue to alternate between fear and greed. The investment bank has set a price target of $3,500 for the precious metal. Historical precious metals bull markets typically ended when monetary authorities successfully addressed the underlying economic issues driving investors to gold. If gold is flashing the same warning signs seen before past market crashes, will investors act in time, or will history repeat itself? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.